Hello everybody and welcome to the October 2020 monthly market report. This is for you if you are a real estate agent needing to inform a client or prospect on the current market, or perhaps a financial advisor needing to do the same, or perhaps you are that potential buyer or seller looking to make an informed decision. I'm Paulo Rodriguez. I've been a mortgage professional since 2005 and I'm excited to share data-driven information that will help you with whatever your real estate endeavors may be. We're going to talk about a lot today, as in, can we keep up this momentum? We're going to look at the biggest obstacle we face and what we can expect going into 2021. I'll talk about where a buyer that's fed up with bidding wars might find success, and if you stay until the end, I'll talk about the type of seller that is most likely to give you a listing in this market and what to say to them. I look forward to spending the next few minutes with you, so let's go ahead and get started. We'll start with a quote from the chief economist at First American. As we think about where we are in terms of real estate today, he says, housing has experienced a strong V-shaped recovery and is now exceeding pre-pandemic levels. In other words, we can confidently say that in the housing market, we have experienced a V-shaped recovery. If you remember back just a few months ago, there were a lot of questions about that. Are we going to in fact see a V? Now the jury is still out as it pertains to the overall economy, and if you remember, we've talked about the survey by the Wall Street Journal in which many respected economists said that the overall economy, they believe, will experience some sort of a V, but certainly in housing, we can say we've experienced a V-shaped recovery. And while there are many moving pieces to that recovery, if I was to summarize it into one sentence, it would be that the pandemic has accelerated the decision process of prospective buyers who have now come out of quarantine in numbers that have not been matched by that of sellers, hence the tight inventory and rising prices. For a visual representation of that, we can go to the housing market index created by the National Association of Realtors, which we've been following for the last several months. And just looking at the right side of the V, we can see that we're exceeding pre-pandemic levels in terms of demand, supply, price, and time on market. So as we look at residential real estate, we can confidently say that we have experienced a V-shaped recovery. Now, there are questions about the overall economy, and we're going to get to that in just a minute. But I think when we look at residential real estate, we can say we started out this year strong, and as people were able to come out from quarantine, that momentum continued on. So if we look at some of the key metrics relative to the housing recovery on a year-over-year basis, what are they really telling us? If you remember, last month we talked about getting through some of the pent-up demand and settling into this market, and we've in fact settled into quite a nice market. If you look on the left here, showings are up across the country as tracked by Showing Time, up 60.7% on average across the country as compared to January 1st. We talked about this one last month. Purchase applications are up 25% year over year, pending deals up almost 22%, and existing home sales and new home sales up as well. So all of these indicators saying, hey, we're ahead of where we were this time last year. And this data really suggests we've worked through the pent-up demand and we're settling into a market that is moving along quite well. Now, the challenge you see on the right side of the screen is inventory. Existing home inventory and new home inventory is down 33% for new homes and 39% for existing homes. That is a challenge in the market. And so that brings up the question, can we keep up this momentum? In order to dive into that question, we've got to start to look at the overall economy. We know our business has fared very well during the downturn, and we're certainly thankful for that. But what do we look like in the overall economy? And so I want to take a look at consumer spending across the US as measured by Opportunity Insights. And on the left, we start at January 1st. We can see that we dipped down in April, almost 32% in consumer spending, and it's come back since in what we could say is a wide V-shape to where on average across the country, consumer spending is within 4.1% of where it was back in January. That's certainly an encouraging sign, and we want to see that continue to return as consumers are able to go out and purchase goods and have the jobs and income to be able to do just that. Now, staying with consumer spending, let's take a look at it across the country. And you can see many states, the ones in the blue color, are above where they were on January 1st. In other words, they're positive relative to consumer spending. Then the orange states are slightly negative relative to January 1st, and the red states still lagging behind substantially. Most recently, the unemployment rate is at 7.9%. And if we look at this over the last 5 months, the unemployment rate has come down considerably. Now, like I said last month, I'm not suggesting that 7.9% is a good spot to be in, but we're on the right path and we want to see it come down more and continue to drop. Just a couple of months ago, we were talking about the comparison of unemployment to the Great Depression, the Great Recession, and some of the downturns in the 80s. This table shows the number of months where unemployment has been greater than or equal to 9%. And here in 2020, we've only been in 4 months of unemployment greater than 9%, as compared to the Great Depression, which was 108 months, the Great Recession from a decade ago, which was 30 months, and in the 80s, we were at 19 months. So that puts unemployment in perspective on where we are today versus the past. Clearly, it's nowhere like the Great Depression nor the Great Recession. Now, coming back to housing, the number of people that are in active forbearance is decreasing. We peaked at almost 5 million people in forbearance early in May, and now we're at 3.59 million, and we want to continue to see that fall as people are able to make their mortgage payment. In last month's market report, I expressed concern that the numbers leveled off in August, as you can see on this chart. So the fact that we have continued to decrease is very, very good news. So now that we are in election season, prospective buyers might be saying, okay, we've got high unemployment, we've got people on forbearance. I may just want to wait and see before doing anything because I'm not sure what's going to happen in 2021 and we might see a housing crash. If you're a prospective buyer wondering about this, or if you're an agent running into this objection, that's certainly a perspective that I would argue is brought on by the housing crash of 2008. We've got to talk about why this is not 2008 all over again, and we can address that by talking about 3 key points: inventory, equity, and what experts are saying. So if somebody says, I'm worried about what's going to happen in 2021, I'm going to wait because I think we may see a housing crash. We want to start off by talking about inventory. And you'll remember this image depicting the difference between 2008 and today. And this is updated with the most current information. You can see that today we're in a seller's market, whereas in 2008 we were in a buyer's market with an oversupply of homes on the market relative to the number of people that wanted to buy them. Back in 2008, we had anywhere from 10 to 12 months of inventory on the market. And where do we stand today? Well, we sit at historically low inventory across the country. This graphic goes all the way back to 1999, and we're currently at the lowest point in available inventory for the number of people that want to buy homes. When we saw oversupply back in 2008, that led to price depreciation, whereas today we're in very much an appreciating market because of the lack of supply in homes across the country. The second way I would address the I want to wait and see objection from a buyer is in talking about equity. Equity gives people options that keep them away from being distressed sellers. John Burns Consulting tells us that 42.1% of homes in this country are currently owned free and clear, and that over 90% of all homes have at least 10% equity. That is a significant amount of equity across the board. We've talked about this in prior months, and how cash out refinances and how people have handled their equity has been very different since 2008. There were a lot of lessons learned from back then. Fast forward to today, we've done things differently. Available equity gives existing homeowners an option to weather a financial storm, and if they did need to sell because they couldn't make their housing payment, they could just put their house on the market, pay a commission, and put some money in their pocket to provide for their families, where back in 2008, that wasn't the case. Now, are some homes going to go into foreclosure? Sure, yes, they will. That happens in our business and will happen due to the pandemic. But like we discussed last month, it's likely to be a trickle and not a flood of foreclosures. So the third factor to talk about in addressing the wait and see objection is, what are experts saying? Experts are not calling for price depreciation in the coming months, and you can see here the majority of experts are calling for between 3 and 4% appreciation, and I expect some of these to be revised up. So in addressing the wait and see housing crash coming objection, we need to hit on those 3 key points I just talked about, and we can summarize them by simply saying that the market is very different to 2008 in that there is a lack of supply coupled with very strong equity, which is leading experts to correctly forecast appreciation going into next year. The one obstacle, however, the obstacle that could be the impediment to our growth in housing and the recovery, is the lack of available inventory. I almost feel like a broken record because I've talked about this previously. We're at a severe shortage across the country in the number of available homes for the number of people wanting to buy them. Interesting quote here from Realtor.com. Since the beginning of the COVID pandemic in March, nearly 400,000 fewer homes have been listed compared to last year, leaving a gaping hole in the US housing inventory. As a result, home prices are accelerating at double last year's pace. So we don't have the inventory and we are in an accelerating market because so many people want a home, can't get a home, and it's driving prices up across the country. If we look as well at the National Association of Realtors Seller Traffic Index, we see across the country still a lot of gray, a lot of folks reluctant to put their home on the market for sale for a number of different reasons. If you take a look at the year-over-year change in listings, as we bring listings to market, the available inventory has continued to drop. Literally, people buying homes as fast, if not faster, than we're able to list them. Although new home inventory is coming to market, we still need more of it. Now, if you're a real estate agent with a buyer that is losing out to higher bids, this chart will interest you. If we look at existing home sales on the left being up only 10.5% and listings down 39%, we clearly have more sales than we have inventory coming into the market, creating this challenge. New home sales, however, look interesting due to the 43% growth, and this makes perfect sense. The only motivated sellers in this market are property developers, builders that sell homes for a living. So if you're looking to end your bidding war woes, perhaps a new construction home is the answer. Now, we've talked about people wanting to move from urban areas to suburban areas, and I want to take a quick look at what the numbers look like. Certainly, suburban areas are outperforming urban areas in the recovery. You can see how the numbers break down on this table. But I must admit, I'm surprised the differences are not larger. Nevertheless, this helps you get perspective on the performance of both. Clearly, what's driving people's decisions, what's on their minds, are things like being in a less dense environment, more living space, a backyard, a home office, enough space to homeschool the kids, all of these pandemic-related reasons. John Burns Consulting says builders we spoke with in the active adult space told us some standing inventory numbers are low, and some builders are tripling the number of standing inventory homes they produce to satisfy the demand. Some are also simplifying what they offer in their homes, a process that streamlines housing production and keeps new home prices more attainable. That further supports the point I just made about having an easier time to go under contract if purchasing a home from a builder rather than an individual that lives in their home. The other piece that is very apparent in the market is equity. Here's another quote from the chief economist at First American, who says this: as homeowners gain equity in their homes, they're likely to consider using that equity to purchase a larger or more attractive home. The wealth effect of rising equity in today's market. Fast rising demand against the limited supply of homes for sale has resulted in continued house appreciation. So, as real estate prices appreciate, what's the good news there? Well, it's providing more equity for people, which gives them more options. And as we look across the country, the average home in the second quarter gained almost $10,000 in equity. And that leads me down the path that surely now is the right time to sell a rental property. If you're an agent prospecting listing opportunities, you might say, hey, Mr. Landlord, how did it go collecting rent during the pandemic? And with winter on the way, will we have a second wave? More shutdowns? How's your tenant going to pay if that happens? And with sellers in such control of this market, why don't we name our price, go to market, and take some profit off the table? Just a thought. So that's a wrap for the October monthly market report. I appreciate you listening in. I'll be back next month, but before I go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks again for tuning in. Bye for now.